this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast that follows our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. I'm excited for this episode. One of our favorite episodes here. We're back for another Mastermind episode.
We are back.
I said episode like 4 times in that sentence.
You did. But that only means one thing, and it means we are joined by Julia Lee. Julia, welcome.
Great to be here. Thanks.
So Julia is Chief Investment Officer at Berman Invest and has been on the show multiple times, and we very much appreciate her time. If you have just joined us for the first time here at Equity Mates, welcome. The idea of these episodes is that we will each put forward a company that we've had our eye on or that has come across our desk in the last few days. And this is not a buy, this is not a hold or a sell recommendation. It is merely just an opportunity for us to talk about our research process and a bit about the stock and bounce some ideas off each other and get each other's thoughts. So that is what we're going to do today. One stock each. No time like the present.
No time like the present. I mean, we've fallen into a bit of a running order here. So, I mean, let's keep it consistent. And that means you get to kick off proceedings, Bryce.
I get to kick off with usually a well-known stock. Julia comes in with a gem and then you come in with an obscure, not.
Keep Ren's stock picks weird is going to be my motto.
So this one, so I'm going to be chatting about Kathmandu. The ticker is KMD. There's been a lot of discussion about this one in the Equity Mates community. So I thought I'd have a bit of a look at it given my love of retail. And I'd just really like to get your thoughts on it as well. So Kathmandu, for those that have never come across it, it is in the specialty retail sector on the market. So think JB Hi-Fi, Super Retail, City Chic, Nick Scali, those sorts of companies. It is a New Zealand company, dual listed, with a market cap of about 1.16 billion New Zealand dollars. The Kathmandu company or group is a global outdoor lifestyle and sports store company with some iconic brands you may have heard and a focus on sustainability, which I'll touch on a bit later. It is building a portfolio of brands that provide a pretty good diversification across the world now, a few different sales channels, and they're really trying to focus on seasonality, which is important for their growth. They're really focused on surfing and outdoors, and they are fully vertically integrated. So they do everything from the design, the manufacture, distribution and retail of all their products. So in terms of their brands, they have Kathmandu, Rip Curl and another brand, Oboz, and they operate in New Zealand, Australia, North America, Europe, Southeast Asia and Brazil, with about 328 retail stores and 7,300 wholesale doors as well. Company founded back in 1987 and is based in Christchurch. So another one of those gems coming from New Zealand.
Can I interrupt there for a sec? I don't know about you, Julia, but I've never heard of the Oboz brand before.
When's the last time you went hiking?
Is it a hiking brand?
Yeah.
Okay.
I've never seen you don on hiking boots.
I don't own hiking boots.
There you go.
Okay. So it's a hiking boot company.
Yeah, footwear.
One of the best?
The best.
Wow.
I don't often go hiking either, so I can't make an assumption on one of the best, but yeah, it's hiking boots. Do you know it, Julia?
Well, I'm just having a look online and all of the Oboz shoes are on sale. Usually, the high-end ones retail for about $320 a pair. They're $255 at the moment if you want to buy a pair.
There you go.
There you go. That is non-sponsored, but Kathmandu, you might need to come and, sponsor Equity Mates.
So I'll have a look at the numbers. Revenue, about 800 million New Zealand, compound annual growth over the last 5 years was about 14.5%. Interestingly, though, from about 2014 to 2019, the compound average annual growth has been 6.5%. So they've really improved on that.
Or COVID was an outlier.
Or COVID was an outlier, yes. Profit of $8.5 million, significantly impacted by COVID. Pre-COVID profit was about $57 million. They did have to shut a large amount of stores, and given that there's no travel to the Northern Hemisphere for ski season and those sorts of things, they have been significantly impacted. It's been quite a journey for Kathmandu shareholders in terms of price. I remember we were looking back at Kathmandu when we were at uni, and it went on a pretty significant run and then just got absolutely slammed, and has been on a bit of a roller coaster since.
Yeah, Kathmandu, like starting in the ones, getting to the mid threes, and then falling back to the ones.
Yeah, and then I think at COVID it hit 70 cents, and now it's back at about $1.50. So yeah, it's been on quite a ride. I just want to touch on the three brands because you've mentioned it, Ren. Oboz. So they bought Oboz back in 2017, 2018 for about $75 million. It only contributes to about 8% of total sales, but it is in the footwear business. So this was an acquisition for them to get into that space and start hitting some international markets. Kathmandu, we all know Kathmandu. It's 31% of sales. And they're really hoping that with a bit of renewed interest in local travel, that's where this is going to generate revenue from them in terms of camping and beach and footwear, because, as I said, their travel markets have really been hampered. But the big surprise packet is Rip Curl. So they spent $350 million buying Rip Curl back in 2019. The surfwear market is valued at about $11 billion, so pretty big market. Rip Curl has contributed to 61% of sales last year, and it is very much part of their diversification strategy. And we know that through COVID, there was a huge increase in participation in surfing, both here in Australia and over in Europe. So no wonder that it was a significant generator of revenue over the last sort of 12 months or so. Yeah. So any questions thus far?
Yes, I have a question. So recently, the CEO of Kathmandu, they've decided it would be Michael Daly, who was the Rip Curl CEO for 8 years. So what do you think that means in terms of strategy and direction? Does it mean that, this is going to be a Rip Curl growth-driven stock rather than more of an outdoor sort of hiking-driven stock?
Good question. Yeah. So their previous CEO, Xavier Simonet, he did resign in, I think,
November 2020.
2020, I think. Yeah. And he's now heading up Austrade. Yeah. So Michael had been running Rip Curl for the last 8 years and has obviously done a very good job. My feeling is that there's no doubt the market that Kathmandu are playing in still has some pretty significant upside given where it is at the moment. Should borders reopen sooner rather than later and Aussies get back out and start travelling again, I would be surprised if they don't refocus back on getting Kathmandu to revenue where it previously has been. But given that Rip Curl's performing so well, I wouldn't be surprised if they continue to try and push that as well.
Yeah, I would imagine that a lot of investors would be surprised that the biggest driver of revenue, not growth, but just like the biggest share of revenue comes from Rip Curl, given the stock is called Kathmandu.
Yeah, well, I saw in some forum somewhere there was it was on the investor call transcript, I think, that someone asked, are they going to rename the group so that it's more reflective of the brand of or the collection of brands now rather than just your traditional Kathmandu? And
what was the answer?
There was no answer. It was kind of a next question situation from the company.
Right.
Yeah, they didn't really have an answer for that.
See, I'm old school. When I think of Rip Curl and Billabong, I think of the fashion brands. So, the swimming costumes and the T-shirts and the shorts. But actually, it's wetsuits. So it's more surfers targeting, I guess, a higher priced product.
So just to close out, the thing that I obviously like about this and all retail companies that are capable of doing it is that they are generating greater penetration of online sales. They now have online sales of about 13%, up from 8.5%. Kathmandu specific penetration is closer to 14.5%. However, Rip Curl online sales growth has again been pretty significant across key markets. So 107% growth in the USA, almost 50% growth in Australia, and almost 80% growth in Europe. So they're doing pretty well on the online side of things. And for those that are interested in the sustainability piece, Kathmandu are a certified B Corp, which means they meet the highest standards of verified social and enviro performance, public transparency, legal accountability, and those sorts of things. And they have reached its carbon neutral milestone 4 years ahead of schedule. So they've done well there, whatever that means though.
Yeah. Did they change anything or did they just buy credits is always my question. But let's not get into that.
So look, for me, this is a company that, as I said, I think has some pretty good upside should borders reopen sooner rather than later. Then there's going to be increased participation in outdoor and increased, comp growth, which is important for retail stocks. They had the previous CEO, Xavier, come in who restored, earnings and profit growth and began the transformation from, that Australasian company through to a global company. It's got pretty good free cash flow, lowish sort of net debt, and it has been battered by COVID. So if we're able to reopen our borders and get everyone back to the Northern Hemisphere ski season and stuff, I think there's some upside. The bear case, competition from big outdoor US brands, interest rates we spoke about last time. If interest rates were to rise, potentially less discretionary spending. In case you asked me that question, Julian, put me in the hot seat. But the bear case is also that borders don't reopen sooner and we kind of stay in this holding pattern for longer than expected. And then obviously that short-term comp growth becomes something for investors to consider. So yeah, an interesting one. Keen to hear your thoughts.
So a question, is the growth story around Northern Hemisphere sales bouncing back? Because obviously domestic sales have been relatively strong given Australians and New Zealanders are travelling domestically, and we're probably peak outdoors at the moment given our lack of ability to travel.
Yes, is the short answer to that.
It's a really good podcast if you only give one word answers, Bryce.
Yeah, I think it's that given the seasonality, we are sort of restricted here, and from reading the transcript calls, the company is really hoping that we can get more Australians travelling, and as such, I think the spread of sales across a 12-month period is going to be less concentrated in just the summer or just the winter. And for that, we need borders to be open so that we can get dual seasonality. So I think the growth component of this is likely to be more on the Kathmandu business than, say, Rip Curl or Oboz. But for that to happen, we're going to need more travel.
And what about the Rip Curl brand? Where's that growth going to come from? Is it Bali, Hawaii, sort of, or is it just more of a domestic focused strategy?
Julie, you're asking the tough questions. No, I mean, I think they bought it with the intention to take it more international. I think they bought it straight from the founders, both Aussie guys, and it did have a bit of a small international presence, but they really want to get the growth from overseas, and we can see that is happening at the moment, particularly with online. So they're probably looking at USA and Europe for growth in that side of the business as well.
Sounds good.
So, look, I met you in Canberra, Bryce, and for anyone who's ever spent time in Canberra, everyone spends about 6 months permanently in a Kathmandu down jacket down there. It gets cold. But it feels like there is a lot of competition out there for that outdoor spend, and especially as they go global, there are bigger companies with deeper pockets over in the US and stuff like that. Does Kathmandu have any comparative advantages?
I mean, they talk about their customer loyalty, net promoter score. They feel like once they get customers in, they're pretty good at that through their loyalty program and that sort of stuff. But a jacket is a jacket in my eyes, and I think here in Australia, they
not in Kathmandu's eyes though.
I think here in Australia they have a pretty strong brand, particularly obviously over in New Zealand as well. But there is no doubt that international markets over in the US, Macpac is a big competitor for them, another very well-known brand. So no doubt as competition, as they expand, competition is only going to get stronger. I couldn't give you the ins and outs on the quality of their jacket, how they make it. Should have done some due diligence on that. But
a jacket is a jacket until you're caught hiking in the rain.
That's it.
Freezing your butt off.
Or until you're in the middle of a Canberra winter in a house with no
they
heating.
do make very good jackets. I can attest to that. I can attest to that. But yeah, I think they're up against some pretty strong competitors overseas. So look, neither bullish nor bearish. Just thought I'd do it on behalf of the Equity Mates community because they've been talking about it a lot. I remember when it hit 70 cents in COVID and everyone was talking about this is a buy, this is a buy. Well done if you did.
Yeah.
It'd be interesting to see where it goes from here.
Nice work.
Nice one. Well, Julia, would love to hear your stock pitch, but before we do, we'll just hear a quick word from our sponsors. So Bryce has discussed Kathmandu, ASX ticker KMD. Julia, we're very excited to hear what you have for us today. What stock are you bringing to the table?
So it's a bit of a controversial one, and it's Costa Group. And the reason why it's controversial is that recently it came out with a disappointing update to the market. And usually I like to see positive momentum and an upgrade cycle in a stock. So Costa Group's a little bit different in it's more of a turnaround play. And the reason why I chose this is when there is a disappointing update to the market from a company, one of the questions I like to ask myself is are the conditions that drove this downgrade or disappointing news going to last forever? Or are they a once-off thing? And some of the things that drove that downgrade are a temporary thing. So I think this is an opportunity for longer-term investors to jump into Costa Group. And Costa Group, for anyone who doesn't know, is the largest horticultural company in Australia. So they do things like avocados, berries, oranges, citrus, tomatoes, mushrooms. So basically in the fruit and veg category. And they not only look at farming, but also packing. They look at marketing and distribution, not only to Australia, but also China and Morocco are key destinations as well. They have been around for a very long time. I think it started off as a fruit shop in Geelong in the 1800s, somewhere, the late 1800s. So a massive history in terms of fruit and veg in Australia. And look, at the moment, what we've seen is strong international conditions, but weak domestic conditions. So it's really about the domestic conditions sort of bouncing back. So that's Costa Group. Did you want me to go into some of the details?
Yeah, sure.
Yeah, I like to break it down because I like eating my fruit and veggies, and Australians love their avocados. They're smashed avo on toast. So let's start with avocados. And I guess when you look at the different categories, some of the things I look at is pricing and volume. So I think they're the two key things that I look at. And avocados at the moment, if you've been to the fruit and veg shop, it's all about the Hass avocados. Very good quality at the moment. I could have been a grocer. Good volumes coming through, but weak pricing because there is a lot of supply. So you can buy avocados at the moment for $1.
Yeah, Bryce has been banging on about it in the office.
I know.
Avocados are cheaper than apples, blah, blah, blah.
It's so good. It's so good.
So yeah, avocados at the moment, good volumes, but weak pricing there. So if we saw pricing coming up, that would be a positive thing. Berries, you're seeing good pricing, strong outlook. The berry category is looking pretty good at the moment. Citrus is an interesting one because in the first half of the year, we saw hail and also fruit fly restrictions. And of course, that's a once-off thing. So that's not going to last forever. So some of those conditions are going to reverse. And in fact, in the second half, growth should be driven by the citrus category. And the good news around citrus is that most of the yield is in the second half. So there is a seasonality element to it. So citrus should be strong in the second half, and that should drive a rebound. Tomatoes, you may have noticed, about a month or two ago were relatively cheap. You could get tomatoes for like $3.50, $4 a kilo, but now pricing has come back up. So tomatoes are actually about $7 a kilo if you can find it at that price. So tomato pricing is improving, which is a positive, and that bodes well for the second half. Now, the problem area was mushrooms. Demand is strong, but with mushrooms, you basically need labour throughout the whole year. So it's a 12-month thing. But you may have noticed in Australia there's a lot of labour shortages going on because our borders are closed. So your traditional sort of fruit picking overseas travellers, they're not coming through at the moment, and those labour shortages are impacting on the mushroom market. But once again, I see this as a temporary thing. Once borders reopen and we see travel coming back, then we should see those labour shortages easing. The other thing I try to look at is growing conditions as well as water. And, you know, a few years ago we had drought, which was a major impact on a grower like Costa Group. But those conditions have also reversed. And actually growing conditions are pretty good at the moment. So, look, I think the market is sort of discounting Costa Group because of the recent bad news that it had. And it's discounting it on temporary measures. The other thing is that Costa Group is looking at another citrus acquisition. It's been looking to expand in that citrus category, and it's made a few acquisitions. So they are doing a discounted capital raising around the $3 mark. So once again, I think this is an opportunity to get into a quality agricultural company that's been impacted by short-term factors. Look, the key question I usually ask myself when I'm jumping into a stock is, do I think that most of the bad news is already out there and priced in, so that the good news starts to be priced in and the share price starts to move back up again?
Now, Julia, there's a few points there that would love to touch on. You mentioned the acquisition, and we're recording this on the 24th of June, and yesterday they announced the $200 million buyout of 2PH, which is a citrus growing
Yes, over in Queensland.
Yeah. So I was reading about that before we started chatting today, and well, one thing that I read is that it takes 8 years to grow a citrus tree, which just is a long time in the business world. But a big part of that is about that 2PH has a brand in Asia, and Costa is looking at it to give them greater export supply into some Asian markets. Is that really the long-term thesis behind Costa, like becoming a real agricultural exporter?
Yeah, I mean, if you have a look at the domestic market, they have made a few acquisitions, but the export story is really quite exciting. And international performance has been strong, whether it's to China or to Morocco. So I think it does make sense to focus on the export market, which I think will only grow for them. So, yeah, the citrus and exporting citrus, I think, is a good strategy, and one that's likely to pay off for them. I think what I like about Costa Group is when they do make these acquisitions, they do focus on strong cash flow, and even within their business, they focus on strong cash flow. So although they're doing a capital raising here to fund this purchase because of the size of the purchase, usually when you look at Costa Group, because of their strong cash flow, they're able to invest and also grow organically with that cash flow as well, which I like.
And then you mentioned the constraints around farm labour for Costa, and hopefully, you know, everyone gets vaccinated, borders reopen, and we can get more international travellers in, and that's eased a little bit. But we did just see the Australia-UK trade deal, and the one of the I guess the items in that was that British backpackers would no longer have to do the farm labour to extend their visas. Is that a concern? Will there be plenty of other backpackers that can fill that void?
Yeah, you know, when we have labour constraints, agriculture is still a major area for Australia. So I think that when you're looking at migration into Australia and visas, that when there are labour shortages, that our government's actually quite good at trying to address that and make room for that. So whether it's issuing more visas to fill that gap. So look, I'm not too worried, because you're coming off a situation at the moment that because of COVID-19, you're really seeing a lack of travellers, full stop. So from this position, I think you are going to see only improvement coming through, even with that trade deal. So I'm not too worried about the labour needs, because I think that is going to be addressed, and any improvement would be an improvement from now. So I think we're seeing a bottoming out in terms of those labour shortages because of vaccinations and also borders slowly reopening.
Julia, I remember they did have a massive berry issue a number of years ago as well. And when I think about Costa, I always think about, the revenue mix between all the different products that they are growing. And I always thought that, they were pretty heavy into avocados, but what is the mix, and how do you think about them being too reliant on, say, citrus and going hard on that? Should all of that come unstuck through, I don't know, fruit fly or whatever it may be? How do you think about that longer term?
That is a good question, and Costa has been working very much on diversifying its crop mix, which I think is a huge positive. And obviously, that mix would change year to year depending on the volume and the pricing. So, I guess to give you a bit of an idea around what we saw last financial year, the biggest category was citrus at $280 million, and then you're looking at berries at about $200 million. Mushroom almost 200 million as well, and then tomatoes about $120 million, and avocado about $150 million. So you're looking at a relatively well diversified company in terms of the different categories. Obviously, citrus has seen a large amount of growth. To give you an idea of the amount of growth, last financial year, you're looking at sort of 280 mil in terms of revenue, but if you sort of went back 5 years, you're looking at about $180 million worth of revenue. So there's been significant growth there in the citrus category, and also targeting that export market. So I think when you're looking at the different categories, I think that citrus would have to be a key driver, especially given the acquisitions that they're making in this space as well.
So citrus, berries, mushrooms, avocado, tomatoes. I'm just trying to think, is there anything that ties those 5 categories together? Are there similar growing conditions, or does Australia have a comparative advantage in each of those? It just feels like a little bit of an eclectic mix of fruits and veg.
They're all delicious.
Yeah, for me, the odd one out sort of would be around the citrus and the avocado. But I guess the difference is in also the IP now. Things like mushrooms, berries, tomatoes, avocados, you're getting all year round. So it's not like the old days when you were only getting seasonal fruit, you were only getting the berries in summer. They're actually grown all year round now, which I think is a huge positive and really opens up the market for Costa Group. But also the export markets, we know that in terms of Asia, it's a massive growth market. So I think that's an exciting story as well. The risks, of course, are that, like any agricultural company, there's an impact to the stock. And we've seen that in the past, whether it's through hail or fruit flies or disease. So that's always a risk that's there for not only agricultural companies, but aquacultural companies, so anyone raising fish or animals. But having a look at conditions, I think growing conditions are sort of the best they've been in Australia over the last 5 years.
Well, Julia, Bryce has been getting stuck into me in the office for my basic fruit choices. I'm a big fan of bananas, apples and mandarins, whereas he's more on the exotic side of the fruit spectrum. So I would love to see Costa get into some more of those meat and potatoes, basic fruits, just for me.
I mean, the other thing with a company like this is that, yes, most people, eat mushrooms, berries, tomatoes, citrus and avocado. So usually when I go to Harris Farm, one of the things I'm always looking at is mushroom prices, tomato prices, blueberry prices, avocado prices. And that's something I do every few days.
That's one thing we appreciate about you, Julia. You really embody that, take information from everywhere around you. I remember when we spoke, when infant formula was booming and you were scouring the shelves, looking at what was being discounted, what wasn't available. It's a good lesson for us and for everyone in the Equity Mates community that there is so much data out there if you know where to look.
Oh, yeah. Meat's really expensive at the moment. Have you noticed? Red meat, like beef.
No, I haven't. Bryce hasn't noticed because he has a personal shopper
what are the volumes
that buys
like?
for him.
Yeah, and that's the other thing. Sometimes when I go to Coles or Woolworths, because I love cooking beef cheeks and they're hard to find, is sometimes they're not in stock at all. So I'm wondering if there's a shortage, but I'll do a bit more research and maybe the next podcast.
Okay. And then, Julia, one final question about Costa, unless Bryce has anything more. Has this mouse plague affected them?
The mouse plague.
Yeah.
It's a good question. I think the mouse plague has mainly impacted, when you're storing silos of things like wheat and grains. So a lot of these fruit now are sort of grown in greenhouses. And I don't think the mouse plague has impacted hugely in terms of Costa Group as yet, but definitely the grain companies. But the flip side of that is that the grain crop's much bigger than previous years because of growing conditions. So actually the crop size is probably going to offset the impact of the mouse plague, even though it's a big problem.
Love it. Well, that was Costa Group. Thank you, Julia. As always, certainly got a lot out of that one.
I can't wait to hear Rand. She's always got something unusual and international.
Yes, unusual and international. May not even be listed. I'm not sure.
It is definitely listed. I'll guarantee you that.
All right. Well, before we jump in, we'll just have a very quick word from our sponsors. All right, Ren, it is time for yours. Take it away.
So, as you guys know, podcasting is booming at the moment. It's the growth industry of the 2020s is what I'm hearing from my sources.
Okay.
And this company that I'm going to talk about is highly exposed to this podcast boom. But I'm also labeling it the most secretive IPO of 2021 because we haven't seen any press about it in Australia. So the company is Acast. Bryce, I'm pretty confident you're familiar with it. Julia, have you heard of it?
No.
Okay, so Acast operates a worldwide podcast marketplace connecting podcast creators with advertisers. And basically, if you take a step back, every podcast you listen to, from Joe Rogan to Equity Mates and everything in between, is distributed by a podcast host. We upload podcast files and then they get released to the world through Apple and Spotify and all of that. And Acast is one of those podcast hosts that sort of sits behind your Apple Podcasts or your Spotifys or anything like that. They were founded in 2014 in Sweden. And just a quick side note, Sweden is the home of audio. Spotify founded in Sweden, Acast founded in Sweden. If you want to do a digital audio startup, I feel like Stockholm's where you need to go.
Yeah. They're killing it.
And in terms of equipment as well, broadcasting equipment and things like that, seems to be a centre for
a Swedish thing?
Yeah.
There you go. Well, I mean, if we're talking audio equipment, we have to give a shout out to Rode, a great Australian company that is taking on the podcasting world. But that's not the stock I'm here to pitch. Started in 2014. By June 2021, Acast had approximately 28,000 hosted shows with approximately 3 billion listens. It doesn't have massive market share in Australia. It's got massive market share in Britain. I think like 90% of the podcasts in Britain are hosted through Acast. It's growing in the US. It's growing in Europe. And it's just IPO'd in Sweden on the NASDAQ. It's the NASDAQ First North, I think, is the exchange. But we haven't really seen any press about it in Australia or anywhere else. And I'm not really sure why that is. It's a really interesting company for me. And I guess I'll talk about why I think the industry is interesting and then why I think Acast is interesting within the industry. So podcasting is globally worth $9 billion and it's expected to grow at about just under 30% a year to 2027, taking it to about $65 billion.
Wow, that's huge.
Good industry to be in, Julia. But, that's driven by this transition from analog to digital audio, and the winners of that are the losers of that are radio. The winners of that are Spotify, Apple Music, and podcasting. According to Business Insider, 78 million Americans listen to a podcast at least once a week. So that's 1 in 5. And that number has doubled since 2016. In a survey of marketers, in 2015, 10% of them said they would likely advertise on a podcast in the next 6 months. In 2020, so 5 years later, that number was 37%. So listeners are growing, advertisers are moving across. There's a lot of tailwinds for that industry. And so then the question is, where does Acast fit into all this? So as I said, almost all creators are linked with a podcast host that distributes their shows and supports with sourcing advertisers and stuff like that. In Australia, some of the big ones are Nova, Australian Radio Network, Listener, which is Southern Cross Austereo, Whooshka, and then Acast. Globally, you have companies like Spotify, that they bought a hosting platform. You have SiriusXM. You have online companies like Podbean, Buzzsprout, but Acast is a big player globally. So basically, the way that they make money is taking a cut of advertising revenue that they source for their podcasters. And so I jumped onto Ticker, and for the Equity Mates community, if you want to use Ticker, it's free. Ticker, tikr.com/equitymates. So I jumped onto Ticker and pulled some of their numbers, all in US dollars. Last 3 years, revenue of $20 million, then $39 million, then $72 million. So 90% growth, then 86% growth. That's not bad. They are not profitable, So in 2018, they lost $10 million. 2019, they lost $14 million. 2020, they lost $21 million. So despite revenue growing strongly, their cost base is growing strongly as well. Costs have grown from 30 million to 53 million to 93 million. So it's very much in that growth and expansion phase, but that revenue growth is good to see. With this IPO, from what I could gather, they've raised between $200 and $250 million US dollars. And that's important because on Ticker, I had a look at their balance sheet and they didn't have a lot of runway. So they lost $20 million in 2020. On their balance sheet, they had $35 million in cash, $35 million in receivables, $30 million in current liabilities. So net current assets of $40 million, and they lost $20 million a year. So 2 years runway, really. So I think this IPO gives them a cash buffer, and hopefully they can continue to grow and capture market share in the growing industry. So that's the company. I want to talk a little bit about future prospects because there's some interesting stuff happening in the space, but I'll pause there. Do you guys have any questions about the company?
Sure. Do you know who their major competitor is? Who would be are they the biggest one in the world?
Yeah.
Or?
Well, this is a great question, and it's actually a nice segue into this future prospect stuff. So the industry, there are some big competitors that are moving into the space. The podcast hosting space traditionally was a lot of startups. There wasn't a lot of value in that part of, I guess, the supply chain. But now people are starting to realize that there's a lot there. So Spotify is loading up. They recently purchased Megaphone for $235 million. They've purchased a bunch of other things in the space. So they've bought Gimlet, the creative house, $300 million, Parcast, $56 million, Anchor, $150 million, The Ringer, nearly $200 million. So that's almost $1 billion that they've spent on podcasting. iHeart acquired Triton Digital for $230 million and Stuff Media for $55 million. SiriusXM, the US digital radio player, purchased Stitcher for $265 million and Simplecast for $30 million to get into the space. And they've also invested $75 million in SoundCloud. So they're trying to become a big player as well. And then Apple and Amazon are getting into the game a little bit. Amazon bought Wondery, a creator, for between $300 and $400 million. Apparently Apple was sniffing around that deal as well. So it's a lot of those names that are either coming from radio like iHeart and Sirius XM, or who are getting into digital audio like Spotify, Apple and Amazon, that are all, I guess, shaping up to be competitors.
Sounds tough.
Yeah.
But also what's interesting is that they are the biggest, they have the most podcasts in the world on their platform.
Yeah.
Wow.
Yet seemingly don't have the firepower as some of these big competitors. So is this just a numbers game for them that they need to get more and more podcasts on as fast as possible and then start monetizing them as soon as possible?
Well, I think in some ways, yes, but in some ways, like, more is not better. I think what you've seen with Spotify's strategy is they're going to target the big and they don't really care about the tail. They want Joe Rogan, they want Barack Obama, they want Kim Kardashian, they want Gimlet Media, and then they want to make it all exclusive. Acast strategy is a little bit different. Like, Acast is basically, they want to be this like key point in the supply chain of podcasts, if you can call it that, where if advertisers want to advertise on podcasts, they go to them. And then if podcasters want to create podcasts, that Acast has the best relationship with all the advertisers, and, the tech and good tech. So then it's just like the natural choice. And look, I mean, we can speak from personal experience that we were happy when we moved across.
Yeah, it's just an interesting one because we sort of believe that as time goes on, advertising the cost at which you can charge to advertise is obviously going to become less and less as more podcasts come on. So then it really comes down to the relationship that these companies have with advertisers, and I guess, they're not going to be serving, or do they have 30,000 podcasts on there at the moment? They're probably only serving the top 1%.
Potentially, but I think the industry, we'll see. Like, it could go the way of the website where it's just all programmatic and it's like Google based, and then everyone gets some, but no one gets a lot. Or it could go the way of like, radio or TV, where it's like there's a few big stations and then there's a distribution that doesn't get much. It'll be interesting to see how it plays out. But I think, obviously, this is just talking about, we're not making buy, hold or sell recommendations,
No.
but I think Acast is positioned well to capitalize on the trend. The big question is just, can they compete with the likes of Spotify? If Spotify decide we want to take the part of the value chain that Acast is focusing on that Spotify aren't as focused on, if they decide we want to focus on that, it'll be interesting to see how they compete.
Yeah, it's an interesting one for me. Given their size, I'm surprised at their market cap and their balance sheet. And, it's okay to be the biggest in terms of having 30,000 podcasts on your platform, but if only 3 of them, the BBC and The Economist, are the ones that you generate,
and Equity Mates
are the ones that you generate revenue from, then you kind of have a key man problem. So I think for them, it's making sure that they still get the biggest podcasts in the world, not just the most.
Yeah. I think they, like Spotify, Apple soon, Amazon, all take money from customers. Like, that's their key focus. Acast don't. Like, they take money from marketing agencies. And I think in some ways it's a different model. Like, I don't know if Spotify is going to resource a sales team to say, we're going to compete for briefs, we're going to pitch ideas. Like, Spotify want a programmatic advertising thing, and then they want to take subscription revenue from customers. So it feels like they're trying to chase different dollars. They're both chasing podcasting advertising dollars, but I would be surprised if Spotify said, we're going to build a global sales team to go and do the big marketing agency shows and do bespoke campaigns. Yeah. I mean, look, I could be wrong. Like, they got the money, but it's just like Acast has a different focus at the moment.
Nice. Well, anything from you, Julia?
No, I thought it was really interesting. It's almost like running a radio station company, but a more modern one.
Yeah. I don't know if they would appreciate being lumped in with some of the radio stocks. They haven't. The Australian radio stocks aren't doing that well at the moment. So hopefully Acast don't follow them.
No, but with the growth, I mean, the modern versions.
Yeah.
Structural growth coming through.
Well, nice one, Ren. Thank you. There you go. Another obscure one that
So obscure that you can't buy it in Australia.
You can't buy it
You
in
might be able to through interactive brokers, but like this is just a
You've got to get over to Sweden. Well, Julia, as always, thank you for your time. We certainly appreciate you coming on the show, sharing your thoughts and helping us think about how we do our research and think about the companies that we're discussing here on Equity Mates. So an absolute pleasure.
Always love chatting to you guys. Thanks for having me on.
Thanks, Julia.
Equity Mates Investing Podcast is a product of Equity Mates Media. All information in this podcast is for education and entertainment purposes only. It is not intended as a substitute for professional finance, legal, or tax advice. The hosts of Equity Mates Investing Podcast are not financial professionals and are not aware of your personal financial circumstances. Before making any financial decisions, you should read the product disclosure statement and, if necessary, consult a licensed financial professional. Do not take financial advice from a podcast. For more information, head to the disclaimer page on the Equity Mates website where you can find ASIC resources and find a registered financial professional near you. In the spirit of reconciliation, Equity Mates Media and the hosts of Equity Mates Investing Podcast acknowledge the traditional custodians of country throughout Australia and their connections to land, sea, and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander people today.